On October 19th, 1987, the Dow Jones Industrial Average plummeted 508 points, a 22.6% single-day loss that vaporized $500 billion in paper wealth before the closing bell. Monday, October 19th, 1987. By 9:30 a.m., sell orders flood the New York Stock Exchange. The Dow opens down 67 points, but within hours, the decline accelerates. Traders watch in disbelief as the index sheds 200 points in the final 90 minutes. Volume hits a record 604 million shares, double the previous peak. The crash is global. Hong Kong falls 45%, London 26%. No single event triggers it. Instead, a confluence of factors creates a financial avalanche. Institutional investors widely adopt portfolio insurance, a strategy using stock index futures to hedge against declines. The theory: sell futures as the market falls, offsetting losses. But on Black Monday, this creates a feedback loop. As prices drop, computers automatically sell more futures, driving prices lower, triggering more selling. By day's end, $2 billion in futures are dumped, overwhelming buyers. The safety net becomes a trapdoor. Program trading, where computers execute large baskets of stocks simultaneously, accounts for 60% of NYSE volume. When the sell programs kick in, specialists, human market makers, cannot keep up. Many stocks stop trading for hours, leaving investors blind. The disconnect between futures prices in Chicago and stock prices in New York widens to a historic 20%, paralyzing arbitrage. The machines have outpaced the humans. The crash begins in Asia, sweeps through Europe, and hits the U.S. with full force. But the root is not economic. GDP is growing, interest rates are falling. Instead, a dispute between the U.S. and West Germany over interest rate policy earlier that month spooks bond markets, sending yields soaring. This triggers the initial stock sell-off that portfolio insurance amplifies. A political spat becomes a financial contagion. On Tuesday morning, the financial system teeters. Banks refuse to lend to securities firms, threatening a credit freeze. Federal Reserve Chairman Alan Greenspan issues a one-sentence statement. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. The Fed pumps billions into the banking system, and the panic subsides. In the wake, the SEC introduces circuit breakers, automatic trading halts when a market drops 7%, 13%, or 20% in a day. These pauses aim to prevent panic selling and give humans time to assess. The Brady Commission Report blames the crash on the breakdown of coordination between stock, futures, and options markets. Yet, no one is prosecuted. The crisis is deemed a systemic failure, not a criminal one. For individual investors, the crash is devastating. Many had piled into stocks during the 1987 bull run, often on margin. When brokers issue margin calls, they are forced to sell at the bottom. One small investor, a retired teacher, loses $200,000, her entire savings, in a single day. She never returns to the market. The psychological scar lasts a decade, with retail participation remaining low until the late 1990s. Black Monday reveals a brutal truth. In a crisis, liquidity vanishes. The assumption that you can always sell at a reasonable price is a mirage. When everyone rushes for the exit, the door narrows. This lesson is not about avoiding stocks, but about understanding that markets are not always rational or liquid. Diversification and a long-term horizon are the only true hedges against the next flash crash. Fast forward to May 6, 2010. At 2:32 p.m., the Dow plunges 998.5 points, nearly 9%, in 36 minutes, only to recover most of it by the close. The cause? A single large sell algorithm executed by a mutual fund in Kansas, using an aggressive volume participation strategy. High-frequency traders amplify the move, then withdraw from the market, evaporating liquidity. The SEC later finds that the algorithm sold 75,000 mini S&P 500 futures contracts in 20 minutes, overwhelming buyers. Just like portfolio insurance in 1987, the 2010 flash crash is a feedback loop driven by automated selling. When prices fall, algorithms designed to minimize losses sell more, accelerating the decline. Circuit breakers, designed after 1987, fail to trigger because the drop happens too fast for the 10% halt. The market structure has changed. Human specialists are replaced by electronic market makers who can step away, leaving no backstop. The lesson of liquidity illusion repeats. Despite reforms, the fundamental vulnerability remains. In a highly automated, fragmented market, a sudden loss of confidence can trigger a cascade that overwhelms safeguards. The 2010 flash crash was not an isolated glitch. Similar mini-flash crashes occur regularly in individual stocks, ETFs, and even treasury bonds. The system is more efficient, but also more brittle. The next Black Monday may not come from a single day, but from a series of cascading failures across interconnected markets. What would you have done? Tell us in the comments. Subscribe to Ledger Noir and uncover the stories money tried to hide.